Let me ask you something. When was the last time you saw major financial institutions actively trying to discourage you from buying something that was actually bad for you? Think about it. They push credit cards with predatory interest rates. They sell you complex derivatives you don't understand. They bundle mortgages into securities that nearly collapse the global economy. But precious metals? Suddenly they're concerned about your portfolio diversification. That should tell you everything you need to know. Right now, there's a quiet panic spreading through the banking sector, and it has nothing to do with interest rates or loan defaults. It's about gold and silver, and more specifically, it's about what happens when millions of everyday people start pulling their wealth out of the system and converting it into physical metal. Because here's what they don't want you to understand. Every ounce of gold or silver you take possession of is one less ounce they can use to play their paper games. The mechanics of this are fascinating, and once you see how it works, you'll understand why your financial advisor gets uncomfortable when you mention buying physical precious metals. Let's start with the COMEX, the Commodities Exchange in New York, where gold and silver futures are traded. On any given day, there might be contracts representing 500 million ounces of silver trading hands. Sounds like a lot of silver, right? Here's the problem. The actual physical silver sitting in COMEX warehouses may be 150 million ounces on a good day. You're looking at a ratio of more than 3 paper claims for every physical ounce, and that's being generous. Some analysts put the real ratio closer to 100 to 1 when you factor in all the unallocated accounts, ETFs, and derivative products. Imagine if 3 people showed up at a car dealership, each holding a title to the same vehicle. That's essentially what's happening in the precious metals market, except instead of 3 people, it's 100. And instead of a car, it's your financial security. Banks have built an entire empire on this fractional reserve system for precious metals. They take your money, tell you they're holding gold or silver for you, and then they lend that same metal out to 10 different parties. Everyone's happy as long as nobody actually asks for physical delivery. It's the same game they play with currency, except with metals there's a hard limit. You can't print more gold. You can't create silver out of thin air with a keystroke. And that's what terrifies them. Central banks understand this better than anyone. While mainstream financial media was telling you that gold was a barbarous relic, central banks were buying it at the fastest pace in over 50 years. We're talking about institutions that literally create money out of nothing, and they're exchanging that money for physical metal. The People's Bank of China added over 200 tons to their reserves in a recent 18-month period. Russia was accumulating before sanctions complicated their reporting. Poland, Hungary, Singapore, India, Turkey, they're all stacking physical gold like their currencies depend on it, because they do. But here's where it gets interesting. These aren't just purchases for the sake of diversification. These are strategic moves in a much larger game. When China buys gold, they're not buying paper contracts on the COMEX. They're taking physical delivery, flying it to Beijing, and storing it in vaults that Western auditors will never see. They're removing that gold from the system permanently. Every ton that leaves London or New York is one less ton that can be used to suppress prices through paper manipulation, and the banks know exactly what this means. There's a reason why gold lease rates, the cost of borrowing gold, have been spiking during periods of stress. When physical demand exceeds available supply, the whole fractional reserve game starts to break down. Suddenly, those 100 paper claims on a single ounce become a problem. Someone's going to be left holding a worthless contract while everyone else walks away with real metal. Let me tell you about what happened in the nickel market recently, because it's a perfect preview of what could happen with gold and silver. A Chinese tycoon had massive short positions in nickel, betting the price would fall. Instead, it skyrocketed. Within days, nickel prices doubled, then doubled again. The London Metal Exchange, facing the collapse of one of its major members, did something unprecedented. They canceled trades. They literally rewound the market, erasing billions in legitimate profits, because allowing the short squeeze to continue would have destroyed the exchange itself. Now imagine that scenario playing out in gold or silver. Imagine millions of investors simultaneously demanding physical delivery of metal that doesn't exist. The exchanges would face an impossible choice: default on contracts or admit the whole system is a fraud. And before you think that's impossible, remember that we've already seen it happen on a smaller scale. In the early days of the pandemic, premiums on physical silver coins were running $8 to $10 over spot price. You could sell a silver contract for $25 an ounce, but try to buy an actual coin and you'd pay $35. The paper price and the physical price completely disconnected. That disconnect is the crack in the foundation, and it's getting wider. Every time someone takes delivery of physical metal, every time someone pulls their gold out of an allocated account and puts it in their own safe, every time someone converts their paper silver ETF into actual bars, that crack spreads a little further. The banks can see it happening. They can see the inventory levels dropping. They can see the premiums rising. And they're scared. Because here's what happens when the system breaks. It's not a gradual decline. It's not a slow adjustment. It's a rush for the exits, where everyone realizes simultaneously that there aren't enough seats. The price of physical metal doesn't just rise, it gaps up in ways that make historical moves look tame. We're talking about the kind of price discovery that happens when decades of suppression suddenly reverse. When the real supply and demand fundamentals finally matter more than the paper games. Think about the actual supply situation for a moment. Gold mining production has been essentially flat for years. The easy deposits have been found. The ore grades are declining. It takes longer and costs more to bring new mines online. Meanwhile, demand from central banks, from Asian consumers, from industrial applications keeps growing. Silver is even more interesting because it's both a monetary metal and an industrial commodity. Every solar panel needs silver. Every electric vehicle needs silver. The green energy transition everyone's talking about? It's incredibly silver intensive. And unlike gold, most silver gets consumed in industrial applications. It's not sitting in vaults waiting to come back to market. So you have declining production, increasing industrial demand, and on top of that, you have investment demand from people who are starting to understand that their currency is being systematically devalued. That's not a recipe for stable prices. That's a recipe for a supply crisis. And the banks know it. They've run the numbers. They understand that if even a small percentage of paper metal holders demand physical delivery, the whole system implodes. Now, I want to take a brief aside here, because this is relevant if you're thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, there's a way to get physical gold into those accounts without triggering tax penalties. I put together a free guide that covers exactly how gold IRAs work, the rollover process, the custodian requirements, all of it. It's in the description below. Worth checking out if you want to understand your options for protecting retirement wealth with physical metal. Anyway, back to why banks are genuinely concerned about this trend. It's not just about the fractional reserve problem, though that's certainly part of it. It's about control. The entire modern financial system is built on the premise that banks control the flow of money. They're the intermediaries for every transaction. They're the gatekeepers for your wealth. They can freeze accounts. They can impose negative interest rates. They can bail themselves in by taking depositor funds if things get bad enough. We saw that in Cyprus. We've seen the legal framework put in place in other countries. But physical gold and silver? That's outside their system. That's wealth they can't confiscate with a keystroke. That's value they can't inflate away by printing more currency. That's a store of purchasing power that exists independent of their control. And that's what really scares them. Because if enough people figure this out, if enough wealth moves from the banking system into physical metal, their power diminishes. You can see this fear manifesting in subtle ways. Financial advisors are trained to discourage precious metals allocation beyond maybe 5% of a portfolio. They'll tell you metals don't generate yield. They'll point to periods where gold underperformed stocks. They'll talk about storage costs and liquidity concerns. All technically true, but missing the entire point. You don't hold physical metal to generate yield. You hold it as insurance against the system itself failing. You hold it because throughout human history, when currencies collapse, when governments default, when banks fail, gold and silver retain value. The Roman denarius was 95% silver when the empire was strong. By the time Rome fell, it was less than 5% silver, the rest base metal. The currency had been debased into worthlessness, but the silver itself, still valuable, still money. That pattern has repeated across every civilization that's tried to cheat the fundamental laws of economics. You can't create real wealth by printing paper. You can create the illusion of wealth for a while, but eventually, reality reasserts itself. And we're living through one of those periods right now where the illusion is starting to crack. Look at the numbers. The Federal Reserve's balance sheet exploded from under $1 trillion before the financial crisis to nearly $9 trillion at its peak. The European Central Bank, the Bank of Japan, the Bank of England, they've all done the same thing. They've created trillions in new currency units, and that money has to go somewhere. Some of it inflated asset prices, some of it inflated consumer prices, and some of it, increasingly, is flowing into precious metals as people realize that currency debasement is the policy, not an accident. This is why you're seeing premiums on physical metal remain elevated even when paper prices pull back. This is why mints around the world can't keep up with demand for coins and bars. This is why delivery times have stretched from days to weeks to months for certain products. The physical market is tight, getting tighter, and the banks are caught in the middle. They've sold more metal than they have. They're counting on most people never asking for delivery, and that bet is starting to look increasingly dangerous. Consider what happened with the silver squeeze movement. A group of retail investors on social media realized that silver was one of the most manipulated markets in existence. They started buying physical silver and shares of PSLV, a trust that holds actual physical metal. Within days, premiums spiked. Dealers sold out. The establishment media went into overdrive trying to discourage people from buying. Why? Because if that movement had continued, if it had grown large enough, it would have exposed the fractional reserve fraud in the silver market. It would have forced a default or a price explosion that would have validated everything the gold and silver community has been saying for decades. The banks managed to contain that situation, but it was a close call. And it showed them something important. The internet has changed the game. Information spreads faster now. Coordination happens in real time. The ability to manipulate markets through information control is diminishing. When thousands of people can fact-check claims instantly, when they can share data and analysis freely, when they can organize buying campaigns with a few clicks, the old playbook doesn't work as well. This is why you're seeing increased efforts to control the narrative around precious metals. Articles explaining why gold is a bad investment. Analysts on financial television dismissing silver as a speculation. Regulatory scrutiny of dealers and mints. These aren't coincidences. These are defensive measures by a system that sees the threat. Because the threat isn't just to bank profits, it's to the entire structure of modern finance. Let me explain what I mean by that. The current system works because everyone believes in it. You believe your bank account has value because you trust the bank and the government backing it. You believe your retirement account will be there when you need it because you trust the institutions managing it. You believe the dollar in your pocket will buy roughly the same amount of goods next year because you trust the Federal Reserve to maintain stability. But what happens when that trust erodes? We're seeing the early stages of that erosion now. Inflation has destroyed the purchasing power of savings. Interest rates, even after recent increases, are still negative in real terms. The national debt has grown to levels that can never be repaid through taxation alone. The only way out is inflation, printing more money to service the debt, which further erodes the currency's value. It's a death spiral, and people are starting to notice. When they notice, they look for alternatives. And the oldest, most proven alternative is precious metals. Gold has been money for 5,000 years. Silver has been money for just as long. They've survived the collapse of every empire, every currency, every financial system that's ever existed. They're still here. They're still valuable. And they're still the ultimate form of wealth insurance. The banks understand this history. They understand that when confidence in the system breaks, the rush to real assets becomes unstoppable. They've studied the Weimar Republic, where people pushed wheelbarrows full of worthless marks to buy bread. They've studied Zimbabwe, where a $100 trillion note couldn't buy a loaf of bread. They've studied Venezuela, where the currency lost 99% of its value in just a few years. In every case, those who held physical gold and silver preserved their wealth. Those who trusted the system lost everything. Now, I'm not saying we're headed for hyperinflation tomorrow. The situation is more complex than that, but the trajectory is clear. The debt can't be repaid. The promises can't be kept. The pension funds are underfunded. The Social Security system is insolvent. The only question is how the adjustment happens. Does it happen through honest default and restructuring? Or does it happen through currency debasement and inflation? History suggests the latter. Governments always choose inflation over default because it's politically easier. You can blame inflation on external factors. You can pretend it's temporary. You can implement price controls and other measures that make it look like you're doing something. But the result is the same. The currency loses value, savings are destroyed, and those who saw it coming and positioned themselves accordingly are the ones who survive financially. This is why the banks are scared of the precious metals trend. Because every person who converts paper wealth into physical metal is one less person who's vulnerable to currency debasement. One less person whose wealth they can quietly confiscate through inflation. One less person who's dependent on their system. And it's not just individuals. We're seeing countries make similar moves. The BRICS nations, Brazil, Russia, India, China, South Africa, have been discussing alternatives to the dollar-based system for years. Those discussions are accelerating. They're talking about trade settlement in local currencies. They're talking about a commodity-backed currency. They're talking about gold playing a role in international trade again. If that happens, if the dollar loses its reserve currency status, the implications are enormous. The United States has been able to run massive deficits because the world needs dollars for trade. If that changes, if countries can trade without dollars, the demand for dollars collapses. And when demand collapses, value collapses. The banks see this coming. They see the geopolitical shifts. They see the economic fundamentals. They see the technical setup in the precious metals markets. And they're positioning themselves accordingly, even as they tell you to stay away. Major banks have been accumulating gold mining stocks. They've been taking positions in physical metal through various vehicles. They're hedging their exposure to the very system they're part of. That should tell you something. Because here's the thing about banks. They're not stupid. They're greedy. They're often corrupt. They're certainly willing to take risks with other people's money. But they're not stupid. When they see a threat to their business model, they adapt. And right now, they're adapting by quietly accumulating the very assets they publicly dismiss. It's the oldest trick in the book. Discourage others from buying while you accumulate. Then, when the price explodes, you're positioned to profit while everyone else scrambles. This is why you need to think independently about precious metals. Don't rely on what your financial advisor tells you. Don't trust the mainstream media narrative. Look at what the smart money is actually doing. Look at what central banks are doing. Look at what billionaires are doing. Ray Dalio has been vocal about gold. Stanley Druckenmiller has talked about the importance of hard assets. These are people who understand markets at the highest level, and they're not dismissing precious metals. They're accumulating them. The supply and demand fundamentals support this view. On the supply side, as I mentioned, production is constrained. But it's worse than that. The quality of ore being mined is declining. The energy costs of extraction are rising. The environmental regulations are getting stricter. The easy gold has been found. What's left requires more capital, more time, more energy to extract. This means that even if gold prices rise significantly, supply won't respond quickly. There's a lag time of 7 to 10 years between discovery and production for a new mine. The supply response to higher prices will be slow. On the demand side, you have multiple drivers all pointing in the same direction. Central bank buying, as we discussed. Asian consumer demand, particularly from China and India where gold is culturally significant. Industrial demand for silver and green energy applications. Investment demand from people seeking inflation protection. Jewelry demand, which remains strong despite higher prices. All of these sources of demand are structural, not cyclical. They're not going away when the economy improves or when interest rates change. They're permanent features of the market. When you have constrained supply and growing demand, the price has to rise. It's basic economics. The only reason prices haven't already exploded is because of the paper market manipulation I described earlier. But that manipulation has limits. It works until it doesn't. And we're approaching the point where it doesn't. The physical market is too tight. The premiums are too high. The disconnect between paper and physical is too obvious. Something has to give. When it gives, the price adjustment will be violent. We're not talking about gold going from $2,000 to $2,500 over a few years. We're talking about gold potentially doubling or tripling in a matter of months as decades of suppressed price discovery happen all at once. We're talking about silver, which is even more manipulated, potentially seeing even larger percentage gains. These aren't predictions. They're possibilities based on the fundamental setup. But they're possibilities that the banks are acutely aware of and deeply concerned about. Because when that price explosion happens, it validates everything the precious metals community has been saying. It exposes the manipulation. It reveals the fractional reserve fraud. It demonstrates that the emperor has no clothes, that the financial system is built on sand, that the promises can't be kept. And once that revelation occurs, once people see it clearly, trust in the system evaporates. That's the nightmare scenario for banks. Not just losing money on bad trades, but losing the confidence that allows them to operate. This is why they're scared. This is why they're trying to discourage you from buying metal. This is why they're working overtime to maintain the paper price suppression scheme. Because they know that if it breaks, if the real price of gold and silver is discovered in a free market, everything changes. The wealth transfer from paper assets to hard assets would be historic. The revaluation of precious metals relative to currency would be stunning. And the people who positioned themselves ahead of that move would be the ones who preserved and grew their wealth, while everyone else watched their purchasing power evaporate. So what does this mean for you? It means you need to think carefully about your exposure to the financial system. It means you need to consider what percentage of your wealth is held in forms that banks control versus forms that you control. It means you need to understand the difference between paper claims on metal and physical metal in your possession. It means you need to act before the crowd figures it out, because once everyone's trying to get through the same door, it's too late. The banks are scared because they see what's coming. They see the mathematical inevitability of the current system's failure. They see the physical metal shortage developing. They see the loss of confidence in currencies and institutions. They see the geopolitical realignment away from dollar dominance. They see all of it, and they know that precious metals are the escape hatch. The question is whether you see it too, and whether you're willing to act on that knowledge before the window closes. Because make no mistake, there is a window. Right now, you can still buy physical gold and silver at prices that, while elevated from historical lows, are still reasonable given the fundamentals. You can still get delivery in weeks rather than months. You can still find reputable dealers with inventory. But that window won't stay open forever. When the crisis hits, when the rush for physical metal begins in earnest, availability will disappear, premiums will skyrocket, delivery times will stretch to infinity, and you'll be competing with millions of other people who suddenly realized what you're realizing now. The banks are scared because they're on the wrong side of this trade. They're short physical metal through their fractional reserve schemes. They're long paper assets that will lose value in a currency crisis. They're dependent on a system that's reaching its mathematical limits. And they know that when the music stops, they're the ones who'll be left without a chair. The question is whether you'll be standing there with them, or whether you'll have already secured your position in real physical assets that have preserved wealth for millennia. This isn't about getting rich quick. This isn't about speculation or trading. This is about understanding the fundamental nature of money and value. This is about recognizing that paper is just paper, that digital entries in a database are just digital entries, and that real wealth, the kind that survives system failures and currency collapses, exists in physical form. Gold and silver have been that form of wealth for all of human history. They'll continue to be that form of wealth long after the current financial system is a footnote in history books. The banks know this. They've always known this. That's why they hold gold in their vaults, even as they tell you it's a barbarous relic. That's why central banks never sold all their gold, even during the decades when it was supposedly worthless. That's why the smart money is accumulating physical metal, even as the mainstream narrative dismisses it. They know what's coming. They're scared of what's coming, and they're positioning themselves accordingly. The only question is whether you'll do the same.